But let's go ahead and introduce Matt. So Matt's a financial planner or wealth manager based on Cape Cod. I'm going to let him introduce himself.
Yeah, thanks, Rob. So as Rob mentioned, I am located in Cape Cod. I've lived here my whole life. I live in Bourne, and I work at UBS Financial Services, where my partner and I provide wealth management services to individuals and institutions. He and I collectively manage close to $500 million in assets. Been doing that for about 10 years. And then personally, I've been involved with some conservation efforts here on Cape, have served on the board and as treasurer of a local land trust, and have continued to be on a few finance committees on nonprofits here on Cape, in Boston, and one down in New York.
Great. So we'll let you take it away.
Okay, so here's the agenda. The slides we'll go through. And like I said, I think we have about 18 to 20 slides to go through, followed by some Q&A. So I'll first start off by saying, at a very high level, what is an endowment? And an endowment is a fund that's created really by a principal gift, where the gift is kept intact and income from that fund is available to support the beneficiary organization. And endowments can be seeded in a couple of different ways. They can be seeded from board designated funds or with gifts from donors. And sort of, the restrictions there and how the income can be spent is dependent on the type of endowment that you have. And there really are 4 common endowments. So here we have a list of really the most common endowments. It's a term endowment, a restricted endowment, an unrestricted endowment, and a quasi-endowment. Now, as I mentioned before, with the structure of these, most of them are structured to have principal reserved but not available for daily use, where the income is available at least to be taken annually, depending on your spending policy. And we'll go into what all that means and then jump into each of the 4 types of endowments here. So the first is a term endowment. And a term endowment is a fund where income is available to be taken annually in accordance with your organization's spending policy. And the principal is restricted until a certain time or occurrence. So it may be a gift with a 10-year term on it. And then the term or the triggering event is predetermined in the fund policy according with the donor's wishes. At the end of that term, that endowment will dissolve and will become an unrestricted endowment. These are not very common. I can say in the 10 years of working with nonprofits, I've never seen one of these actually used because they are very restrictive. The second type is a restricted endowment. So a restricted endowment is a permanent fund, again, where income can be taken annually and for sort of a specific cause, as indicated by the donor, and the principal is not available for use. So this is a situation where a donor would specify that they were looking to start an endowment to support a very certain cause. So common examples are scholarship funds, or maybe an endowment to, I guess in the land trust world, it would be to support a specific property. Again, these are not very common because they are restricted for the organizations. And one of the things we'll talk about later on in the presentation here is that when you're either receiving or soliciting gifts from donors, it's very important to make sure that each person, both the organization and the donor, is very clear and really understands the language in their gift. Because where we have seen people get tripped up is maybe someone from the organization, to acknowledge a donor's gift, sends an email, and the email says, thank you for your generous endowment gift. Well, what that might, what that states to the donor and what it actually means may be 2 different things. So I'll show some examples too of like gift receipt language that you can use where it's made very clear sort of what the purpose of that gift is going to be. And so third, we have an unrestricted endowment. And an unrestricted endowment, again, is a permanent fund where the income can be taken annually and used for general support of the beneficiary organization. So again, principal is restricted. It's meant to be a permanent fund. The income is available, and it is really up to the organization whether they take that income and how it's utilized. So no restriction placed by the donor on how the organization may spend the income. These are quite common, and they're usually built through specific fundraising campaigns where an organization approaches donors with the express intent of creating an unrestricted endowment. So here I have some language which has been used for a capital campaign from another land trust, and we'll go look at their landing page because I think it's a good example of sort of how you could set up something like this.
Better.
Okay, that works. So this is just an example from another land trust where they sort of they lay out their need for an endowment, and then the capital campaign they're going to initiate. So they say that their aim is to raise $5 million by the end of 2022, due to them doing a strategic plan in 2015 where they outlined the need for an endowment. They said they've received their first gift of $75,000 from an anonymous donor to launch the fund, and they, give an email address and contact information for how you could reach out to them if you're interested in supporting this. The next example we have here is a quasi-endowment, and this is the most common endowment we see across the nonprofit space. So a quasi-endowment, the biggest difference here is that this is funded with funds from the organization's operating reserves that the board has designated. So a lot of the times we'll also hear this referred to as a board designated endowment, which is not to be confused with board designated funds like for stewardship or legal defense or something like that. We'll touch on that later. This is a type of endowment. So you may have heard me refer to the other endowments as permanent funds, which with all the other three, you are not allowed to invade the principal of the fund, typically without a court order. So you will have a spending policy. A typical spending policy might be something like 4 or 5%. That's what you're allowed to spend out of the fund every year, in line with the restrictions outlaid in the fund document. So with a quasi endowment, you would have that same requirement where you can spend funds in accordance with a spending policy, but principal could be invaded, usually with a board vote. That's something you would specify in your investment policy statement or in your spending policy statement. So biggest difference with the quasi endowment between the other three is that principal is available pending a board vote, and some typical language that we would see for a spending policy on a quasi endowment might read as if 4% of the fund is available annually to be appropriated by the investment committee. Anything above the 4% or a hard dollar limit of 200,000 requires a majority board vote. Would be something like that. Before we go on here, do we have any questions on the 4 types of endowments or any clarifications? So what are the main benefits of an endowment? Well, it is a source of income. So the income from an endowment may help create stability and predictability and provides ongoing support to the organization over time. And depending on how the endowment is seeded and what sort of capital campaign you put in place, over time, the returns on investment can add up to a substantial amount of funding. Another benefit of an endowment is that it may lessen the impact of the changing business cycle. So as someone who works with people who are often very charitably inclined, as we see expansions and contractions in the economy, we tend to see donor behavior sort of mimic that. So at times where there aren't a lot of donations coming in, it is nice to have this steady stream of income where you can count on it. It helps with budgeting. It helps with expanding your initiatives. And the other thing is the message it sends to the community. So it really sends a message of strength. It says that we're here for the long term, and it provides donors with a way to create a legacy. One example I would give of that is if you say you have a donor who routinely gives about $1,000 a year, you're looking to start an endowment, and you're thinking about how can I approach this person. You could reach out to them and say, hey, Rob, for the last 10 years, you've given $1,000 a year to our organization. We're thinking about starting an endowment. Here's why. You lay out the reasons why and the initiatives, and tell them that a $20,000 gift to that endowment at a 5% spending rate, well, that now gives us that $1,000 in perpetuity. So would you consider doing that versus giving $1,000 a year? It's another way I've seen people approach donors. And this calculator right here, this goes to my point on how the income and investment returns can grow steadily over time. So this chart assumes a $100,000 start for an endowment and shows you the returns over 10 years. We assume a 7% annualized rate of return, investment cost of about 1%, which is high for an endowment, and a distribution rate of 4%. So you can see in the fifth column over how the grant dollars that come out over time grow significantly. Now, one thing to mention about this is we're using a 7% annualized rate of return, assuming every year it's this endowment's hitting a 7% rate of return. Those rates are obviously going to fluctuate with the value of the investment portfolio, but this is just for illustrational purposes to show how the income can be quite substantial over the long term. So what are the drawbacks? Depending on the type of endowment, your ability to spend the funds may be very limited. So some of those other ones we spoke about, either the term endowments or the restricted endowments, you have to navigate that and work that into your budget planning. Written consent from the donor or a court order may be needed to invade principal on a restricted endowment, and with a court order, the burden of proof is on the organization to prove that either the restrictions of the endowment are prohibitive or for whatever reason, due to changes in your business model, it just doesn't make sense to carry that endowment anymore. There's also a need for volunteer staff education. So as we'll talk about later on in the presentation here, there are some laws that you have to comply with when you seed an endowment, and to manage that, there are the annual requirements, there are policy requirements, and then there are also specific fiduciary duties that each person in the organization might have. So understanding that, and then making sure that you and your donors are on the same page as far as like what the endowment's going to be used for, what type it is, what restrictions might be in place. That involves a lot of infrastructure on the organization side, and then you likely will have to involve a couple professionals, at least as a CPA probably when you first start the endowment. So there's a little bit of an upfront investment there. If you're thinking about starting an endowment and you are, there's really two ways that organizations will start this. So they might run a capital campaign where they look to outside capital from donors to fund it, or they might look internally. So if you've had a few years of operating reserves build up, your capital reserves are in a good place, and you're thinking that it might be time to start an endowment, sort of what are the metrics we should look at to judge our organization's health? There's a couple you have here. So operating reserve, your fundraising efficiency ratio, working capital ratio, and operating margin. And at the end of the presentation, there are links to a couple of resources which will bring you to further explanations of each of these. And there are also calculators where you can plug in your organization's information. So generally, all these ratios just go to judge the financial health of your organization. The one thing I would say about these is there's no specific number or magic number where you would say, yes, this means, we're in a good place. A lot of it is dependent upon your budgeting, your specific short and long-term goals. And, these are discussions that you would have along with yourself, your CPA, and probably your finance committee and your board. So relevant policies, the thing with endowments, as I mentioned earlier, is that you do have there are certain laws that you have to comply with and regulatory filings that you have to complete. And one of those is to have an investment policy statement, a spending policy statement, and a usage policy. So each endowment that your organization maintains, you have to have separate policies for separate fund documents for each of those endowment funds. So an investment policy statement at a very high level that outlines the fund's asset allocation, risk levels, return, and any limitations, along with general management and evaluation of the fund. And this is an example of an investment policy statement. So you can see at the top here, this outlines the purpose. So depending on whatever type of endowment you had, its purpose and any restrictions would be listed here. There's delegation of responsibilities. It talks about the duty of the board, the duty of the investment committee, and then if you hired an outside investment manager, that person will be listed here. So responsibilities of the board, responsibilities of the oversight committee, responsibilities of management. This would be an outside manager. Investment considerations. Here you have some general language regarding MIFA, which is a law which governs the management of institutional funds. We'll talk about that in a few more slides, but I just want to highlight this because we'll come back to this in another slide. Guidelines for investing. And then here we have the allocations to different types of investments, different asset classes. Expenditure considerations. So this is where you would outline your spending policy. Typically, the spending is stated as a percentage of assets under management in the fund. So it would be around 4 to 5% is a typical spending policy. Of MIFA, the law that I mentioned, which we'll go over later, actually it sets a ceiling of 7% for a spending policy. Donor restrictions. So if you have either a term endowment or a restricted endowment, this is where the donor restrictions would be listed on how that income could be spent. And that investment policy sample is, I would say it's long and it has a lot of information. And I actually have one. So I had written an investment policy statement for a client about a week ago, and I will share that. Rob, I can share that with you, and maybe we can get it out to the group later because I just have to redact certain information from it, but it's a lot more straightforward than that one. So the spending policy, as I mentioned, the spending policy outlines the amount of money that's available to be spent annually. It's usually stated as a percentage. Percentage is usually low, and it's done that way so the fund will be able to last in perpetuity. Like I said, legally, there's a 7% spending. There's a ceiling on that spending limit. 7%, I would say would be extremely high. That would be a very high bar.
I'll be very disappointed.
Is there a question?
It's done. It's finished. It's over.
You might
I'm
want
sure I'm going to wind up on the editing floor.
I'll just mute.
Sense.
There we go. There we go.
And then the usage policy determines what the purpose of the income, what it can be used for. So if it is restricted, this is where any restrictions will be outlined. In the past, there have been these policy documents have been spread out into 3. Now the investment policy statement really is this is a cumulative document where all the stuff is outlined.
Matt, I'm just going to anticipate somebody asking if the slides could be available afterwards with those live links. I don't know if that's something you'd want to make available.
Yes. So the slides, the live links, and the other investment policy statement example, I can package that all up, PDF it along with the links, and then Rob, I can either send it to you to send out, or if we have people's emails, I can send it as a batch email.
I'll send it out on your behalf if that's okay. And if you include your contact info, that'd be great.
Yep, I can do that after.
Great.
So these are some governance best practices, just that we've picked up from working with other clients. So articulating the organization's long-term objective and unique needs. So again, the endowment, it serves a specific purpose. So ensuring that everyone in the organization understands what that purpose is, how the funds should be used, making sure all your spending policies, your budget, your fundraising, it's all making sure all that messaging is cohesive is really important. And then when you're thinking about starting an endowment, realistically evaluating your financial resources and your ability to both raise and manage an endowment is key. there's an article here. I won't click on it. It's from the Greenwich Roundtable. They're a really good resource for nonprofits. So if you go to them, it's about an 8-page document, and it lays out in detail sort of the roles and responsibilities that a board plays, what they're able to dictate to an investment committee, and then what an investment committee is able to do to hire an outside consultant. Talks about the roles and responsibilities of each, and it's a very, it's an easy read, but it's also very comprehensive. So that'll be part of the packet that we send out after. Next, we'll talk about understanding the rules that govern endowments. So the big one is UPMIFA, which is the Uniform Prudent Management of Institutional Funds Act. So this is a federal law that has been adopted for a while. It was adopted by every state except Pennsylvania. I believe Pennsylvania has since adopted their version of this. Most states have all adopted the federal version. So to give you some background on that, UPMIFA, which was previously known as UMIFA, was released in 1972, and it created the first universal guidance for how nonprofits should sustain their endowments. A couple key parts of the act were requiring endowments to keep pace with inflation, and it created the historic dollar value requirement, which reflects the fair value of the fund when the gift was received, subsequent gifts to the fund, and donor expectations for the fund. So when UPMIFA was first released in 1972, the historic dollar value requirement basically stated that if I were to gift an endowment of $100,000 to an organization, that organization could only take income off of the fund above and beyond that $100,000. So if at any one given year, the fund value dipped below that $100,000, not only is the principal restricted there, but you could not take any income from that fund either. So you had many endowments that were underwater, and then that language has since been removed. So in 2006, this is when UMIFA became UPMIFA, and the act it replaced the prior guidance. UPMIFA moved away from the historic dollar value limit toward an endowment management approach that focused on preservation of the fund and established specific criteria which must be followed. So I would say the main difference between the two is really moving from that historic dollar value requirement to more of a total return metric. The act was also expanded in 2006 to cover not just endowment funds, but funds held in any form. So the need for an investment policy statement, the need to ensure that your management of funds is in line with UPMIFA, that extends to reserve funds and capital reserve funds as well. So there are a couple factors outlined in the UPMIFA law language, but these are sort of I would say probably the most important ones. And when making decisions regarding your endowment fund, the organization is required by law to take into account the following factors. So we have prudent management, duration and preservation of the fund, charitable purpose, general economic conditions, the need of the fund to make distributions and preserve capital, the effects of inflation or deflation, diversification, the role each investment plays in the overall portfolio, total expected return, and the organizational resources. So what these basically state, if you look at maybe the prudent management, duration, and preservation of the fund, is that decisions must be made prudently with a long-term focus. Number 5, the needs of the fund to make distributions and preserve capital. This refers to the spending policy, return targets, asset allocation, and risk management. These must all work cohesively and be documented in the fund documents. Diversification. So there's language in the law that says unless reasonably determined by the organization, you must diversify your investments. So an endowment that has an allocation to 1 or 2 exchange traded funds likely would not pass the diversification test. And then decisions about individual assets within the fund must be made in the context of the overall portfolio. So what this really tries to do, what this language does, is to take individual decision-making out of it And one thing you want to avoid is sitting in an investment committee and trying to make decisions around one or two pieces of the endowment. Do we buy it? Do we sell it? You always want to refer back to that investment policy statement. And a way to cover yourself from a legality standpoint is to take the UPMIFA language. So I'll include a link to the UPMIFA language which lists all 13 factors, and incorporate that into your investment policy statement. So if you remember the investment policy statement that I showed earlier, it listed these out. Many organizations will just say that, in order to manage the funds, we take into account X, Y, and Z. They list the 13 requirements of UPMIFA. So the key takeaways here are, first, to determine if a MIFA applies to you. If you have an endowment or if you have restricted funds where those funds are invested, then it does apply, given that all states have now adopted that. So you want to evaluate your current policies against the factors outlined in a MIFA. This is your investment policy statement, your usage policy statement, and your spending policy statement. And then ensure interconnectivity. Your policies and your approach to soliciting for your endowment all need to inform one another. And then document your policies and establish a process for ongoing review. A general rule of thumb for an endowment portfolio is that it should be reviewed at the investment committee level. And I say investment committee level, it's probably the finance committee. So reviewed at the finance committee level at least quarterly, and with those results reported to the board annually. The link here of MIFA and why it matters, that is, those are some resources from the state's website regarding the act, and then how it applies to different organizations. So how to write an effective investment policy statement. Investment policy statements really should have a couple main pieces. So first is the purpose. This just states the purpose and general rules of the fund. So any restrictions, gives the organization name, any type of principal restrictions or donor restrictions, and how the income could be spent. The definition of duties. This talks about the duties of the board, the duties of the relevant committees, and any outside investment advisor which might be hired. Objectives. Here's where you would state your return objective, which is always stated in terms of total return. That's capital appreciation and income from dividends and interest. Asset allocation is where you would outline the allowable asset allocation. So it's usually stated in terms of percentages with bands. So if you, and that'll be shown in the example I gave for the investment policy statement. But if you think of a 30% allocation to US equities, that might be then stated with a band. So it would say, that an acceptable band would be 28% to 32%. And your rebalancing strategy. So with that asset allocation, if you're underweighted or overweighted in any one particular place, what's your strategy for rebalancing? Spending policy. Often this is what we refer to as the income, often stated as a percentage. Risk management. So what are your risk management controls? Limitations in responsible investing. If you want to do an ESG investing or socially responsible investing, this is where you would mention that. Then the monitoring and review process. What is the process for that? And the sun is just in the worst place right now in that window. So again, elements of a full investment policy statement. This is the full text right here. It's about a 30-page document, but I'm going to I'll cut that down for you and then send that out in the email after the fact. So board designated funds. We did talk about how a quasi endowment is also referred to as a board designated endowment, but not all board designated funds are endowments. So things such as stewardship fund or an enforcement fund. An enforcement fund might be money set aside for legal fees or to pay legal fees or to those are not endowments, so they're separate. And then a common capital structure of most organizations would be a quasi endowment, an enforcement fund, and a stewardship fund. And this would be separate from any sort of operating reserves or capital reserves. And all these funds are subject to the MIFA rules. They should have their own individual investment policy statements.
Can I, this is where I have a question, Matt. So,
Yeah,
let me say something and you tell me if I've got it correct. So if it were a quasi endowment or let's say a board designated endowment, the board would be stating there that they intend to preserve the principal and only the income should be used until they, you know, alter that through an appropriate board vote. But on the other hand, a board designated fund for, say, stewardship, property stewardship, could be set up. The board is sort of restricting the purpose of that pot of money. But if they're not using the word endowment, then they're not saying that the principal has to be left untouched, right? Like if we
that's correct.
yeah.
That's correct. So it would be the difference between, if you just look at the stewardship fund, the enforcement fund, and then the quasi endowments. So the endowment in itself is a legal term. So it is, that word endowment implies principal restriction subject to whatever it is. If it's a restricted endowment, it's the donor's restrictions. If it's a quasi endowment or a board designated endowment, it's the then, as you stated, it's up to the board to vote to evade that principle. The key word is endowment, because that term in itself is a legal term, which implies some sort of principal restriction.
So you could set up a stewardship fund and know that you're going to need to touch the principal sometimes. You just avoid the word endowment. You call it a purpose restricted fund designated by the board for X. And then you'd be free to use principal if you had to.
Yep, that's exactly right. It's the singular endowment word is the one that changes that. So here is some language. So these are bequest languages that we've seen used when soliciting in donations or just when accepting gifts from donors. So again, to Rob's point here, the language and when you're speaking to a donor or the board is designating funds, the language is really important, and that word endowment is the one that really sort of changes the purpose there. And then these are some resources. So we have donation page examples that different trusts have set up, some stewardship costs. So this really helps to understand like your budget and the short and long-term obligations that you have and kind of like where your organization is financially. And I'll include all these links go to different websites, or documents with some helpful information. So I'll include that all at the end.
Great. Well, that was very helpful, Matt. So let's open it up for questions. Some of you who joined later, I indicated that we'll have a period of questions on the recording, if you will, and then I'm going to stop the recording at a certain point in case folks have questions that are a little more particular that they prefer not to have on tape. Anybody have a question? I'm going to ask one that follows on what we were just talking about. If I hark back to my early days in land protection, the organization I was with had a policy of always raising stewardship funds in conjunction with each new property acquisition or CR that we took on. My memory is it was a long time ago, but I seem to recall that we used the term stewardship endowment. We had the requirement to raise a stewardship endowment in conjunction with each acquisition. But I have to say now in retrospect, I'm wondering if it was really truly an endowment or if we were misusing the term and thereby confusing our donors or perhaps even misrepresenting. I'm just kind of saying this more as a cautionary note that I think people can misuse the term endowment or use it overly broadly when what they're really talking about is raising funds for a purpose. And maybe they're using the word too loosely when it comes to these legal requirements that you're talking about. Have you seen such, casual misuse of terms in your experience? And Barbara,
I have
actually to that point exactly. My question is similar. when, let's say you take on a property and you want to reserve some money to fund its stewardship in perpetuity, I've seen that the in perpetuity is named endowment. So that's wrong, correct? So similar to Rob's question.
It's no, so that would not be wrong. So a board could designate, you can have a board designated endowment, or where a board can designate funds to a restricted endowment where the income is restricted to be used for a specific purpose. So that would be that case there.
As long as that's what you've done. And that actually may have been the case with my the outfit that I was working with at the time, but I'm just less certain about it now than
where we've seen organizations get in trouble is that they may have a larger, maybe a quasi endowment, and then they have some of these other, I'll just call them little offshoots, and they have one policy document that they apply to all these funds. The funds really shouldn't be commingled in any way, both at the custodian level, which means wherever, if you have a bank or investment provider, they really should be in separate accounts so the funds are not commingled. And then each of those separate funds should have its own separate investment policy statement. So it's really documentation and sort of a workflow question, and just making sure that's all in line with the language. And these are questions too, if a good resource for organizations is the CPA. So if you go to your CPA and you talk through with that's really, they're a great resource to help you kind of think about how to separate that out, and then making sure that that's separated out too correctly on the balance sheet is important as well.
When we introduced ourselves, this group, there was one person, I believe, who said they were thinking of starting an endowment. I don't recall who that was. Did they want to ask any questions of Matt? Okay, I guess I was wrong.
No, you were right. That was me.
Okay.
And we actually have an endowment started that was started a few years ago that has a pot of money in it, about $30,000. We're really looking to raise about $2 million, hopefully over the next 10 years. But we're kicking off a campaign for the first 6 months of this year, because again, we don't want to cannibalize on what we ask annually. So we're going to take the first 6 months and try to start building a base for this endowment before we then go and ask for membership fees at the end of the year.
Our land trust was loaned $79,000 by a very generous resident so that we could have enough cash flow to administer our first reimbursable grant. Does this fall into any of these categories that you're talking about in terms of having to have written up a policy? We have nothing in terms of any kind of financial policies for anything. We're a small land trust. We're inexperienced with financial affairs, and this is all very overwhelming for us. Any suggestion? Does this loan need some kind of special treatment?
It doesn't need any, you would want to, so it's not covered under, it's not any kind of endowment or anything like that. The loan, though, you would want to, there is an expectation that you're going to pay that back, I would assume.
Yeah, yes.
And was there agreed upon time frame?
Yes, 2 years.
So you'd want to record that on your that would want to be recorded on your balance sheet. So that loan.
Oh, it is.
You would record that on your balance sheet, and probably a rule of thumb is to write up, just have some sort of agreement with the donor. So probably signed by your president or your board chair and the donor that just states, this is a loan. Is it a 0% interest? They charge you no interest?
It is, and we did have a agreement form written up that he signed, and we have signed.
Then that's really what you'd want for that. The agreement form is important, and just making sure that you record that loan as a liability on your balance sheet.
Okay, great. Thank you very much.
You're welcome.
Matt, I want to go to this topic a little bit of when might an organization want to start an endowment. And I know that, as you mentioned, there's a lot of particularities for each organization. There's no simple answer to that question, but part of the reason I ask is I know that some of our members, particularly some of our smaller members, may not have raised stewardship funds in association with some of their early acquisitions. So I've had a couple of different land trusts say to me, whoa, we realized that best practice would have been to put money aside for our long-term stewardship obligations. We didn't do that in the first 25 years of our existence. And now what? And some of them have undertaken kind of campaigns, if you will, to put some money aside for those needs going forward, or they're contemplating that now. And I guess one of the things that comes up for me is what are the considerations that they might think about, consider in terms of whether to take an endowment path for that versus just trying to raise a war chest, a board designated fund where the principal could be used. And I don't know if there's a simple way to answer that, but I think it's a question that people might have.
I think, my answer to that would be to evaluate the donor base. So look at the donations that they do receive annually. If they started an endowment campaign, would they cannibalize those donations? How much do they think they could realistically raise and over what time frame? And would that, given maybe some projected returns on that endowment, would that be a worthwhile exercise versus just setting the funds aside in maybe a stewardship fund or capital reserve fund where they don't have to deal with some of the complexities of an endowment fund?
Mm-hmm. I could imagine a scenario or a discussion around the board table that might be, let's see how much we can raise for a board designated fund before we start thinking about an endowment. It is a question that could be, they could move to an endowment approach later.
I've seen organizations really, they want to solve for their own liquidity first. So if they're in a good place there and have a few years of maybe built up operating surplus, or they're approached by a donor who asks if they have an endowment fund or we would like to make a gift to one, that's really when there's usually something like that's caused this topic to come up.
Mm-hmm. That's helpful. Yeah. I'm going to go ahead and stop the recording. Thanking you, Matt, for your presentation, which was very informative, but I want to stop the recording just in case anybody wants to ask questions off the recording.